Hello class, I want to pick up where on our Schedule A, Chapter 5 here with interest. I do want to point out that your textbook indicates that home equity interest is deductible regardless of what it's used for. That's the old rule, and that is no longer the case for 2018. So my slides are correct. The textbook, as it is you currently have it, is incorrect. Hopefully we'll be getting that fixed. So going on to charitable contributions is the next section. All right, charitable contributions is everything made to a qualified charity. It must be an actual charity. It can't be just money you give to a friend or something of that nature. Transportation counts. If you make it in non-cash, it still works. However, you have two situations. You have either the tax-based adjusted basis in the property, that's what we paid for it, or the fair market value. And typically, you're going to use the lesser of those two. All right? Unless there are special rules that apply. So when you donate your clothes to Goodwill, it's the lesser of what you paid for it or what it's worth at the time you donate it, which of course is the lesser of that is going to be what it's worth when you donate it. All right, ordinary income property. If you held it short term, in less than a year, or it's inventory of some sort or another, then the deduction is limited to our adjusted basis. So what we paid for it, less any depreciation or any other adjustments. Okay, so artwork to a local museum, paid $1,000 6 months ago, less than a year, it's currently worth $1,800. That doesn't matter. What matters is what you paid for it, $1,000. Capital gain property, or property that has gone up in value and held long term. If you sell this, you're going to produce a capital gain. Now, you never want to donate property that is below what you paid for it in value, okay? Because you won't get a loss for it. You want to sell that property and donate the cash. But if it's appreciated tangible, physically tangible, and it's not used for the charity directly for its exempt purpose, then it's only the adjusted basis. So you donate your car, and they're just going to sell it and take the money, then and use it for the charity. Then that is limited to the adjusted basis in the property, what you paid for it, or the value, fair market value. Okay, of course, in this case, much less if it's lesser. Okay, so you can't use the fair market value if it's higher. Now, this is appreciated. Your car wouldn't be appreciated. Okay. So example, land, which is not a personal property, is $20,000. It's currently worth $23,000 because it's not personal property and it's held long term. You get to deduct the full $23,000, the fair market value. Painting to the hospital, no. Okay, paid for the painting. It's currently worth $4,800. It's held long term, but it's tangible personal property. It's not real estate like the other example. Okay, they're not going to use the painting to do hospital work. So you didn't donate a hospital bed or something like that. You donated a painting, and they're not going to use it for the tax exempt. So it's limited to the $2,000 adjusted basis. If you donate the painting, same painting, but instead of giving it to the hospital, you give it to the art museum, they're going to actually put it on display. That's their charitable purpose. That means you get to use the full $4,800 fair market value. So now you don't have to do something like follow up, make sure they actually put it on the wall or anything like that. But if you're giving art to an art museum, okay, then you can assume that they're going to use it in their exempt purpose and therefore deduct the fair value. Okay, in that case. So after you figure out the amount of the property you're giving, Then we have these limits based on your AGI. Remember, your AGI is you take certain deductions for AGI, and this is another time when this is really important. Okay? You're limited depending on who you're giving the money to or giving the charitable contribution to and what you're giving to either 20, 30, 50, or 60% of taxpayers' AGI. If you can't deduct it this year, you can carry it over, but only for 5 years. Okay, so if your cash is 60% to a qualified charity, and if it's non-cash to a public charity, only 50%. Okay, so that's most of the places you consider to be charities, Red Cross, United Way, those kind of things fall into this category. If you give it to a public charity with a fair market value, so you gave stock or land, and you get to deduct the fair value because it's appreciated, then you limit it to only 30% of the AGI. You can choose to use the adjusted basis, which of course is lower, right? If you want, and only include 50%, the limit becomes 50% of AGI instead of the 30%. So let's look at an example of this. Paying to the Art Museum, this is the same one we did before, 5 years ago, currently worth $4,800. Deduction is $4,800 fair market value. However, that would be limited to 30% of his AGI for Charlie. If that's going to be a problem, he could also choose to reduce his deduction to $2,000 and use the 50% AGI limit. Now, his AGI would have to be pretty small for that to be a difference there in that situation, or he would have other charitable contributions as well. But that's kind of how the choice to make when the AGI limit is an issue. Here's where you report them, right down here in the next section of charitable contributions on the Schedule A. Casualty losses are now very, very limited because they only count if they happen in a federally declared disaster area. So we can ignore this one. Sorry about that one. All right. But this $100 floor and 10% of AGI still applies. So there's no such thing as theft loss anymore, but casualty losses in a federally declared disaster area is the difference between the fair market value before and after the event or the adjusted basis of the property. Okay, and then you subtract the insurance amount. So if your house is worth $10,000, just give you round numbers, okay, before, and then you get a flood and it's only worth $2,000, then your loss is $8,000. That can't be more than what you originally paid for. If you only paid $5,000 originally, then that would be the limit on your loss. And then you take from that any money the insurance gave you. Now let's say you didn't get an appraisal right before and after the disaster. The cost of fixing it back to its normal thing, repairs, can usually be used to take the place of that little I, the difference between fair market value before and after. Then you take $100 out, and then you compare that to 10% of your AGI. You cannot be over, you only get it deducted if it's over 10%. So you've got to have a pretty big casualty. It's got to be in a federally declared disaster area for this to be helpful. All right. Now, Chapter 6, I'm not going to do separate slides on. You have a little bit of reading there, gambling losses and some other miscellaneous expenses. We're not going to have a quiz on Chapter 6 or a separate homework assignment. So you'll just have problems from Chapter 5. However, when you get to the tax returns next week, you will have a tax return that comes out of the homework for Chapter 6 that you will need to complete. So that is your itemized deductions as under current law.